Welcome everyone. With today's video I will talk about how to identify the best liquidity areas in order to understand how to use it in your trading strategy. This video will be a very simple lesson. Most of you probably already know what liquidity is, but the beginners probably don't understand yet. So with this video I hope I clarify all your doubts. The liquidity is basically the stop loss of every trader. It sits at every high and at every low of the market structure. In this case here I made a simple example of this market structure. In this area probably the amount of stop losses is higher than how much it was here, because we have an equal high, which is very easy to find on a daily basis when you're going to trade. And when you see two equal highs like this, you can already understand that here there is a lot of liquidity, because people put their stop losses above these highs. And what price then tends to do, it is probably to create a fake move to the downside, taking the liquidity of the buyers of this uptrend, creating a market shift, and then reverse to the upside, taking first the liquidity and then dropping again, creating the new trend. This is something which you need to consider also when you want to trade the reversal of the trend. If you're a beginner trader, usually you trade double bottoms or double tops, head and shoulders and so on, but these patterns don't work. So many people use them. When something it is well known, it means that probably it doesn't work as it should. So by simply understanding the liquidity, you can easily increase your win rate and you can also improve your trading strategy. Later on I will also talk about the importance of the number 3, which I also explained in the previous videos, but I think it is very important to discuss it in this video, which is more specific about the liquidity. Now let's go on the chart and we see some examples on how to find the liquidity, how to spot exactly the right liquidity to enter. For me, when it comes to find the best liquidity areas, I go first on the higher time frame areas. Later I will explain also this, but first of all I want to show you where exactly the liquidity is. Here there is an example. In this high there is liquidity, there is rejection, so people which then start to sell had the pullback, they put their stop loss above here, price went down. As it goes back up, first it takes the liquidity of the traders which put their stop losses at break even, and also if you see later it dip inside this liquidity area up here, and then look what the drop until it takes this liquidity area here. So basically you have to mark every measure high and every measure low, and you wait for a reaction in that area. If you would have marked this high here, as price dip inside this area of liquidity and closes below this area, this for me it is already an indication for price to drop again, because we didn't close above this wick here. I consider this wick as a sort of resistance. I know most of you which learned the price action would mark the resistance somewhere here, but what's the problem of marking the resistance there? It is that here price closes above, there is a wick to fill, as everyone would see based on the price action. Price go down here, test this area of resistance, which now become a support, and you enter open for price to rise from here, wick filling this wick. But as you can see, after price closes with this candle rejecting the previous resistance, price then drop. This because they want you to think like everyone else. Look at this. If you mark the resistance here, you have a rejection of the resistance, another rejection, and then the volume comes and break the resistance. But what I'm telling to you guys, it is to watch the wicks of the candles, not the body. By watching the wicks of the candle, you understand the high and the lows of the market structure. This example which I explained, it is a very good one, where you can exactly see that price goes from one area of liquidity to the other side of liquidity. Now let's find another example. Here you can see an interesting example of trendline liquidity which got broken and then price went back to the other way. This happened because they want you to get a lot of noise in your mind. We are here at this point. If you see the bigger picture, we didn't break this low here at this point. This area is two equal highs. If you would see it in this way, there is the third point of the trend line, fake move to the upside, you buy here, you lose. You sell here because it break the trend line, you lose. They know that you will get emotional when you take losses like this, and you will get mad by taking also this point of view here of this liquidity. But by taking this point of view here where you understand the liquidity, which is down here, you guess that price could dip down once again to take this low this low and this one here, and then go the other way. You can also see the importance of number 3, which I was telling you before. Let's consider this as a point 1, then we consider this as a point 2, and then we have here the point 3. By simply understanding this, you already know where price is more likely to go. Liquidity, numbers of the points, so there can be the third one. And then price goes the other way. Let's see then if it takes also the liquidity up here. Okay, it didn't take it here, but we have equal highs, so it means liquidity, and then price took it. So this is another great example where price takes one side of the liquidity to go to the next side of the liquidity right here. You guys have to understand also that everyone becomes liquidity. So even if you enter when the liquidity grab is happening, you will be the liquidity for the next liquidity grab. Sooner or later you will be liquidity. This is something which you need to understand. For example, here equal highs, which then they got taken out here. You enter at this point, you take your profits, you leave the position to run with the stop loss at break even, your partial position, because I guess here you already took profits, but then you see you get stopped out. And this, it is because you also become liquidity. So don't be upset if when you enter at the liquidity grab, you get another liquidity grab which takes you out. Think in this way, your usual stop loss which you were always setting before will be now your entry point. And by being patient, you will see that you get really the best entry. That said, I want to explain you very easily how I use the weekly chart during the week and also the daily chart. Every day I check the weekly chart and the daily chart and also all the other lower time frames, because the highs and the lows of the weekly candles are very important for me. They indicate where the liquidity is sitting. So once I marked this high and this low of the previous week, for example, I go on the daily and I see how the daily is behaving at this point. The previous weekly high and the previous weekly low on the daily, they are a measure high and a measure low on the market structure. The daily took out this previous weekly high and then dropped. So this could be an entry for a trade. A lot of times, if I see that this weekly candle takes out the previous weekly high, my bias mainly it is to sell. And as it happened here, the weekly candle took out the previous weekly low, I would be searching for buys. This because I know that at every high and low of the weekly candle, there is the liquidity which sits at the highs and the lows of the lower time frames. That said, the video can finish here. The lesson was very simple and I hope you understood very well how to identify the liquidity. Leave a like and a comment and we will see us in the next video.